Hello, this is Grant from BeatTheMarketAnalyzer.com. In this video, I'm going to talk about how to find good companies at bargain prices to invest in. Now, this technique is based off of Warren Buffett and Benjamin Graham's value investing technique. So first, I'll talk about how to find good companies, and next I'll talk about how to find bargain prices. First, how to find good companies. Let's look at what Buffett did to find good companies. He looked at earnings performance, share price growth, debt levels, profit margins, owner earnings growth, and handling of shareholders' money. Now, if you're confused by these terms, don't worry, it's understandable. Even experienced stock investors get confused because there's a lot of data out there, and sometimes too much data, people get overwhelmed. The good news is that you don't need all of this data, and there's a few essential criterion that we're going to focus on, so you don't have to worry about the rest, which will sidetrack and confuse you. So most importantly, we want to look at return on equity, which is ROE, and also dividends yield. Now, return on equity is very important, and it was one of Buffett's favorite measurements because it took into account a lot of things in one measurement, such as income, assets, debt, profit margins, and other things, and it gives you an overall view of the company's performance. Another thing we're going to look at is dividends yield. Now, dividends yield is important because it tells you directly how much money the company is going to pay you. Now, this criterion directly affects how much money you make. Now, other people focus on different criterion, and sometimes this criterion doesn't really affect you directly. Such things as unemployment levels, politics, currency rates, things like that. It has very little direct effect on the bottom line, which is how much money you're going to make from your investment. So instead of focusing on this stuff, just focus on the most important essential criterion that will give you the best overall picture of the company's performance. Along with return on equity and dividends yield, Buffett would also look at other criterion, such as 5 to 10 year price growth, 5 to 10 year earnings growth, or EPS growth. He would also look at ROIC, or return on invested capital, gross profit margin, PEG ratio, or price earnings growth ratio, and the ability of a stock to recover during an economic downturn. So just looking at these few criterion instead of all of the information, we're drastically reducing the overload of information in evaluating stocks. Now, this is great for us because it saves us a lot of time in finding good companies. The problem is that even with a small number of criterion, the manual process of evaluating stocks is often tedious and takes a long time. I know from personal experience, it would usually take me 30 minutes or more to analyze one stock manually. Now, the reason why it took me so long is because I would set up an Excel spreadsheet and I would go to different websites such as Reuters, Yahoo Finance, MSN Money, and so on, and I would find the data that I needed. The reason why I had to go to different sites is because not all the information is on one site, so you have to jump around. The other thing is that sites will often charge you a fee to get this data. They don't provide all of the data for free, and especially when you're trying to get 5 to 10 year historic data, they'll often charge you for this information. So let's say that we did get the data that we needed, and we punch it into our Excel sheet. Now we still have to compare company A to company B and see which is the better company. After we do that, we compare company A to C, and so on. Now, doing this can be very educational because you can see the strengths and weaknesses of each company, but you can see that it'd be very tedious and time consuming. Plus, you're limiting yourself to the amount of time that you have. You couldn't analyze 500 stocks in one afternoon or even in 1 week. So you're really limiting the number of good companies that you can find. But let's say that you do find a handful of good companies, you still have to find out if these good companies are at a bargain price. So now I'm going to talk about the second part, how to find out if a good company is at a bargain price. So how do we determine if a good company is at a bargain price? Well, we're going to use Benjamin Graham's intrinsic value formula. Intrinsic value is an estimated value of a company based on earnings and other factual data. Once we find the intrinsic value, we can find out if the company's at a bargain price. For example, let's say that company A has an intrinsic value of $100 and the market price that it's selling at is $60 per share. Then we can see that its value is more than its selling price, and therefore we can say it's at a bargain price. But before we'd buy, we'd still want to make sure that we're safe and eliminate our risk even more. So what we do is we'll add a margin of safety. So even if we screw up and overvalue the company, we can still reduce our risk by adding this margin of safety. Now, how does the margin of safety work? Well, let's take the intrinsic value, which was $100, and we'll reduce it by, let's say, 50%. 50% would be our margin of safety. Now, with this stock at $100 and a margin of safety at 50%, the maximum price we'd be willing to pay is, of course, $50. But the current price is $60. So when considering the margin of safety, this same stock is no longer at a bargain price. So this is how we would determine bargain price. Now let's put it all together. You'll take each of your good companies and find out if they're at a bargain price. And just so you know, it won't be easy to find the combination of a good company at a bargain price. Out of 100 stocks, you might find one good company at a bargain price. But when you do, it'll be worth it. Finding a good company means safe and consistent returns with good growth potential. Finding it at a bargain price means lowered risk with higher returns. This is the concept of value investing, and it's definitely worth it. Keep in mind that you can do this manually, like I used to do, or you can use a faster and more accurate method, which I use today. Let's go to a stock spreadsheet that does all of the tedious work for us. I created this spreadsheet for my own investing purposes, and now I'm sharing it with you. At the end of this video, I'll show you how you can download it also.